A reset is already happening. Most people just haven't felt it yet. You're being told the system is strong because the market is strong, but that's the illusion. The real story is that financial prices have separated from real life, and the gap is getting wider. On the screen, everything looks stable. In the economy underneath, the pressure is building. Consumers tighten up, costs rise, and the good news starts feeling rehearsed. Here's the contradiction you can't ignore. US market value has surged past 200% of GDP. That's not a healthy expansion, that's a warning siren. And the CAPE ratio suggests US stocks are priced roughly 110% above the historical average. People are paying double for the same reality. Now watch how fast this escalates. Because when markets stop pricing value, they start pricing rescue. The entire machine runs on one belief: someone will step in and catch the fall. But the moment liquidity tightens just a little, the illusion gets stress tested. And when the floor is belief, not fundamentals, the drop isn't gentle. But here's the part nobody is saying out loud: what happens when the rescue stops working? The US isn't just in debt, it's trapped inside a math problem. America's public debt has passed $37 trillion. But the total isn't the most dangerous number. The most dangerous number is the interest bill, over $1.2 trillion a year just to service existing debt. That's money spent on the past, not on growth, not on infrastructure, not on stability. This is where the story flips, because that interest bill now exceeds the defense budget and consumes more than half of federal revenue, meaning the system is no longer funding progress, it's paying rent on survival. And here's the trap: to pay interest, you borrow more. But when rates stay high, the interest bill rises faster. The machine becomes dependent on new borrowing just to stay standing. You feel that dependency in real life. When interest becomes the biggest expense, everything else thins out quietly. Services get worse without announcement. Taxes creep up without admission. Prices stay stubborn. And stability starts feeling temporary, like something being held together day by day. Notice what they didn't deny: there is no painless exit from a debt spiral like this. So the next question isn't whether the system breaks, it's how it breaks without calling it a break. And that's when the US uses its oldest trick: pushing the cost outward. America doesn't just borrow, it exports pressure. When the US expands money supply aggressively, the consequences don't stay inside the country. They travel outward through trade deficits, reserves, and the global financial plumbing most people never see. It's a simple exchange with a brutal outcome. Newly created dollars get swapped for real goods, real energy, real labor, while the purchasing power of everyone holding dollars gets silently diluted. This is where the story flips. From 2020 to 22, US money supply jumped around 40% in just 2 years. That isn't a policy tweak, that's a shockwave. And when inflation hit, it didn't drift. It spiked to around 8% in 2022, the highest level in roughly 4 decades, forcing the Fed into a corner, tighten conditions, raise rates, and squeeze the very system that had become addicted to cheap money. Here's why that detail changes everything. Because the US needs easier money to survive the debt machine, but easier money reignites inflation. Tightening fights inflation, but tightening threatens markets, credit, housing, and government funding. Either choice breaks something. That's why the system feels like it's stuck in permanent emergency mode. And once the world realizes this trap has no clean solution, demand for the dollar stops being automatic. Now zoom out. This didn't happen by accident, it's what empires do. Every global reserve currency is built on a promise, and every promise eventually gets tested. The dollar became dominant through design, first through Bretton Woods in 1944 when it was tied to gold, then through the 1971 break when the US cut the link and turned the dollar into pure belief. After that, the system needed a new anchor. So the world was trained into a new habit. Energy would be priced in dollars, and dollars would become unavoidable. Now watch how fast this escalates. Because reserve status isn't permanent. It's rented. The British pound once ruled global finance too, until war costs, debt, and shifting production hollowed it out. The story doesn't end with a speech. It ends when the world slowly stops treating the currency like the center of gravity. The dollar's danger isn't collapse tomorrow. The danger is a gradual loss of automatic trust. And when that happens, the empire doesn't just lose money power, it loses the ability to run deficits without consequences. Then Washington made a move that changed the game permanently. It turned the financial system into a weapon. When the US froze more than $300 billion in Russian reserves in 2022, it sent a message every central banker in the world understood instantly: your assets are safe only until politics changes. Notice what they didn't deny. That single move cracked the illusion of neutrality. It told every country, ally or rival, that dollar reserves and US debt aren't just savings, they're exposure. And once reserves become risky, nations don't announce panic. They adjust quietly. And they did. China reduced its holdings of US Treasuries from over $1.3 trillion down to roughly $770 billion, its lowest level in about 15 years. Meanwhile, alternative payment systems accelerated, designed to bypass US-controlled rails. This isn't ideology, it's risk management. The moment money becomes a weapon, people start building exits. And exits don't need to be perfect, they just need to exist. Because now the world isn't trying to replace America. It's trying to stop being trapped by America. And that's where BRICS enters like a slow-moving earthquake. A new architecture is forming, and it doesn't ask permission. BRICS and its expanding orbit now represent more than 40% of global output on a purchasing power basis, larger than the G7. That's not a club, that's a gravitational field. This is where the story flips. Because this bloc doesn't need to defeat the dollar in a headline. It just needs to reduce the dollar's necessity in daily trade. Step by step, deal by deal, commodity by commodity, and the structure is powerful. Energy producers, manufacturing giants, and commodity suppliers inside one ecosystem. If these countries increase settlement in local currencies or build systems like BRICS Pay, the demand for dollars drops, not because people hate the dollar, but because they simply don't need it as much. That's the danger. The dollar's dominance isn't maintained by love, it's maintained by forced usage. The second forced usage weakens, America's deficits become harder to finance cheaply, and then the question becomes unavoidable. If the world doesn't recycle dollars back into US debt, who does? That's why the quietest move in the world is now the loudest signal: gold. Central banks aren't talking, they're acting. For 4 straight years, central banks have bought over 1,000 tons of gold annually, record level accumulation with China and Russia leading the surge. This isn't about speculation, this is about survival. Now watch how fast this escalates, because gold isn't a promise. It isn't someone else's liability. It can't be printed. It can't be frozen by a sanction. It's the oldest neutral asset in human history. And when central banks hoard it, they're not predicting a sunny future. They're preparing for a storm. This behavior signals one thing: a declining trust in pure fiat stability. And it opens the door to a terrifying possibility that keeps showing up in elite logic: a revaluation of gold at drastically higher levels, not to create wealth, but to reset balance sheets and quietly devalue old obligations. If that happens, it won't feel like a policy, it will feel like a world you wake up into. And while central banks prepare, smart private money does something else. It changes its escape route. Because the shift isn't only happening between nations, it's happening inside boardrooms. Chinese tech giants like Tencent and Baidu have been shifting away from borrowing in dollars and toward issuing bonds in yuan, so-called panda bonds. Offshore yuan issuance has surged, roughly tripling from 2021 to 2024, reaching close to $200 billion. Here's why that detail changes everything. Because this isn't just a currency preference, it's an interest rate bet. Borrowing in yuan has been cheaper, around 2.1% versus 4.5% in dollars. That changes corporate incentives overnight, and it signals expectation. These companies believe dollar funding will be more expensive, more volatile, and more politically risky going forward. Meanwhile, capital flows into Chinese bonds and equities began turning positive again after years of outflows, hinting that global investors are testing alternatives. Slowly, when major corporations reposition debt strategy, they're not guessing. They're adapting to a new financial climate, and when the private sector adapts, the public system eventually follows. Now here's the twist most headlines ignore. The fracture is also happening inside America itself. The empire is splitting from the inside out. At least 7 U.S. states have passed laws recognizing gold and silver as legal tender. That isn't a quirky local trend. That is a confidence signal inside the country that issues the global currency. This is where the story flips. Because when parts of the system begin preparing for life outside the dollar, it tells you something deeper. The trust in centralized monetary management is leaking. And at the same time, Washington's politics are turning the debt ceiling into a weapon, creating repeated moments where the world has to wonder, will the U.S. accidentally break its own credit? You don't need to love or hate any side to understand the result. Instability becomes structural, and structural instability changes investor behavior. It changes creditor behavior. It changes how fast people pull money out when the first crack appears. Now personalize it. If you're an ordinary person watching this, you don't experience it as macro policy. You experience it as higher borrowing costs, stubborn prices, and a future that feels less predictable every year. If this feels familiar, say so in the comments. Because when trust fractures at home and abroad at the same time, the dollar doesn't need to collapse. It just needs to lose its automatic dominance. And then the last pillar gets tested, energy. Because petrodollar demand was never optional. It was engineered. And now it's fading. The petrodollar isn't dying in a dramatic explosion. It's dying in quiet negotiations. Saudi Arabia, the cornerstone of the petrodollar era, has openly discussed selling oil in yuan and moved closer to the BRICS orbit. That single shift changes the physics of global finance. This is where the story flips. Because for decades, oil exporters recycled dollar surpluses into U.S. treasuries, helping finance American deficits at lower cost. But when energy trade starts settling in other currencies, that forced recycling weakens. And if fewer dollars come back into U.S. debt markets, the U.S. must offer higher interest to attract buyers, which triggers the trap again. Higher interest makes the debt machine heavier, forcing more intervention, forcing more dilution, forcing more exit behavior. It's a feedback loop. And this is the mechanism the mainstream rarely says out loud. The reserve currency's superpower is the ability to run deficits without pain. The moment that ability weakens, everything changes. Military reach, global influence, domestic stability. So here are the two paths forward, and both are unstable. Path 1, the system tries to maintain dominance through tighter control, harder enforcement, and financial pressure, keeping the dollar central through power. Path 2, the world moves toward a multi-currency order anchored by real assets, regional trade, and reduced exposure to U.S. political risk. Neither path is clean. Both create turbulence, and the momentum is already moving. So the next move isn't coming someday. It's forming right now, quietly, inside bond auctions, central bank vaults, energy contracts, and corporate debt decisions. And when that next move lands, most people won't see it as history. They'll see it as their cost of living suddenly shifting again. Here's the deepest truth in this entire story. Money doesn't disappear in a reset. It moves. What you're watching isn't just a currency story. It's a transfer of power story. The world is drifting from trust-based money toward asset-based reality, from one center to many centers. And that shift doesn't happen because someone announces it. It happens because the incentives change. So ask yourself one question. In the next version of the system, will you be holding paper promises or real leverage? Because the next era won't reward confidence. It will reward positioning. And if you want the next layer, how this reset could be managed, what it means for digital currency control, and how ordinary people get boxed in without noticing, make sure you're subscribed. This story doesn't end with a crash. It ends with a new rulebook,